This is Justin.
And this is Haley. You're listening to The Price of Avocado Toast.
We're a married millennial couple wanting to normalize the conversations around money. We want to hear about your highs and your lows,
the do's and the don'ts on your path towards financial freedom. Hi Toasties! Welcome to The Price of Avocado Toast, episode 4.
Whether you're a first-time listener or you've been following us from the start of this thing, we are so glad to be having this conversation with you today. Today is the start of our real estate series, and we are so hyped. We got to speak with Kelly Pennington. Kelly is a mortgage loan officer here in Sonoma County where we live, and surprisingly enough, Kelly was actually our mortgage loan officer when Haley and I got into the home that we currently live in. We purchased the home back in 2017. We've been here, like 3 years. And we were Kelly's first clients to go all the way through the process with her.
This is a lot of information if you have never looked into home buying and you're just kind of curious. So we will be linking all of her information in the show notes. So,
without further ado, here is our interview with Kelly. All right, you guys, so we're sitting down today with Kelly Pennington. Kelly helped Haley and I get into our home back when we first purchased, and we wanted to sit down with Kelly to start our real estate series because we think her job is super important, and it's one of the first things that millennials need as they get into the home buying process. So Kelly, you are a mortgage loan officer. Let's start by you just telling the listener exactly what it is you do and what your job looks like.
Yeah, so my job is to help you guys with your financials to get a loan to actually buy a house or to refinance your house. Without me, if you were to go with a realtor and try to go shopping for a house, you're literally going shopping with an empty wallet. You don't go to the grocery store without your wallet. And so the first step is for you to come to me, and I'm going to get you pre-qualified for you to know how much you could afford and walk you through the whole loan process.
That's such a cool phrasing for you don't go to the store without your wallet. Like, you need to have your wallet when you go to the store. So why not make sure that you have your wallet and you actually have a number when you go home buying?
Yeah, totally. When we were first looking to even buy a house, we had the inheritance money, but I was on Zillow looking at this house. We contacted the realtor that's through Zillow, and we went and we had no idea where to even start. We weren't even pre-approved. We just knew that we had some cash and maybe we could start buying a house, but we didn't even know anything about down payments or loans or anything. So that's awesome. The first step is to figure out how much can you even afford. So I'm really kind of confused, and hopefully you can help me out. And I know the listeners are asking these questions as well. There's so many players and people involved in the home buying process. So what's the difference between a mortgage loan officer and a mortgage broker, or are they the same thing?
They're similar, but they're different. A mortgage broker is actually either a single person or company, like a small company, that they actually do loans, but they don't have a direct lender. So they don't have the relationships with the underwriters and the processors, and that they have their files, and they bring them to a lender and try to have a lender buy them. So it's kind of like an insurance broker will help you find the best person for a lender, or not a lender, for insurance. But for a mortgage officer like me or a lender, I'm a direct lender. So my Stearns lending, we have the money. We use our own money. We don't have to go out and use other people's money. And I have all the same relationships and really close relationships with our underwriters and our processors, which helps me, actually watch my deal from the beginning to the ending. And that's the difference, is I have more control versus brokers don't, because they just hand it off.
The broker's kind of like the middleman, and you guys are able to just cut out that middleman and function wholly as just a brick and mortar business that's got everything there, all the players kind of in-house.
That's awesome. Thank you for clarifying. So then what's the relationship between you and the buyers and then you and the realtor? Because like I said, there's so many people involved in this. So how do you work with the buyer and with the realtor to kind of figure out the whole home buying process?
is really to like hold your hand. I'm going to hold your hand throughout the to make sure that you could get the loan, because without the loan you can't buy the house unless you're really, really rich, but you know, millennials aren't. But so my relationship, you know, it grows, but my job is to make sure that I keep you informed about what's happening on the loan side. With a realtor, my relationship with them is to make sure that they can trust me, because it's all based on trust, that I'm taking care of you guys and making sure that I'm actually making this loan happen. And that if there is a road bump, that I am trustworthy enough to tell them and let them know, so they aren't blindsided by something with the loan not going through. So it's just, my relationship really just starts with trust, and then from there on it just kind of grows. And one of the things with realtors is we have a relationship that's, you know, if I get anyone that I can refer out, I refer them to like realtors, and they send me referrals. So it's kind of like this referral process. But in the end, they're mostly just my friends, and we hang out and get lunch, and like it's actually amazing. And that's the one downside about COVID, is that I can't go hang out with my friends as much, because you know, all the work luncheons and stuff was really just us hanging out as friends and creating a relationship. And so it's kind of helps us to work with our clients, because we are close enough that we can team up to make sure that our buyers are able to be set up in the right way they need to be and taken care of.
I think that's so important too, because like, at least for us in our relationship, you were there like literally every step of the way, and you did create like such a cohesive relationship for us that I think a lot of people pick their realtor based off of that. But it's nice if literally everybody throughout the ladder is connected and has that close relationship.
Yeah, the entire home buying process, and we refinanced with you 2 times. But all 3 situations, I felt so connected with everything that was going on. Everything was so clearly laid out for us, and I feel like that's so important. Like you said, with the trust between you and the realtor, you're working with all of our money, or the loan money that we don't have. But still, it's a huge purchase. I don't know what you buy unless you buy an island that is worth more than your home. So that's such an important trusting process. So I love that. Thank you.
Yeah. Kelly, where does somebody even start? Where does the millennial listener start if they're interested in buying a home? And like, what does that look like on your end?
Well, the first place they start is by calling me at 707-888-5651. And that will, you know, make my cell phone ring, and I can help you.
Yes, absolutely.
And then the next step is, you know, I like to get to know you, and hear a little bit about what's going on with your life. If you have a job that's, you know, and that you're set up to actually qualify for a loan, because, you know, if we can't qualify for a loan, and just by talking to you a little bit, I can tell. I don't want to pull your credit. I'd rather talk to you and kind of make a game plan first. But if everything sounds great, we do a loan application. I pull your credit. You give me your documentation showing that you proof of your income, and as well as, you know, your assets for your down payments. And that's kind of where we start. So I could look at the whole picture of where you stand and what you could potentially qualify for.
Gotcha, definitely. And I think that's important, again, for people to recognize. I think it's so great that you said you're not going to just set somebody up for failure. You're going to start by building that relationship and really guiding them in the home buying process. And if it's not something that works for them in the moment, rather than put them at risk or put them in a position where they're not going to be able to afford it and to get their hopes up, it's so much better to just be like, hey, it may not be in the cards right now, but let's look at a plan for what's going to help that be in the future for you. I think it's so important.
So can someone call you if they are just curious about, I have a job, I have some cash, I'm thinking about buying a home, but I don't really know if it's in the cards right now. Can they contact you to kind of have that discussion and figure out, okay, well, maybe it's not in the cards now, but if you start planning and doing things accordingly, maybe we can touch bases back in a year? Is that something that people do?
Yes, I actually do that all the time. And I actually prefer, I think it's a great thing because you don't know where you don't know if you could do it unless you have a starting place and you actually could see. So there are times where I've had people like even 2 years where it took them 2 years to actually, stay within their brand new job to get qualified. And if we could set up this game plan, it gives them some more insight and a goal to reach. And it really just kind of helps them with their confidence building of knowing that it's not too far out of reach to get a house. They just have to, maybe change a few life styles, pay down some credit cards. But yes, I think it's the best thing to do is if you are curious is to call and let us just kind of see what your scenario in your life looks like and, line your cards up correctly.
I'm going to reiterate what Kelly just said so the listeners can hear that again. You might have to adjust your lifestyle and you might have to pay off some credit card debts if you guys want to own a home. So make the right choices. Don't think that owning a home is just going to happen on the same lifestyle that you have. You got to make conscious and intentional choices. I think that's so important for people to hear.
But it's not just credit card debt, right? Isn't it like the debt that you have in general and the ratio with your income? Can you explain a little bit about the debt to income ratio and what that entails?
Yeah, so the debt to income ratio is super important. It literally is how much debt you have, and we base it on your credit report, but how much debt you have versus your income. Ratios are changing all the time right now with COVID. Before we could go a lot higher. Fannie Mae and Freddie Mac, which I like to say are the big dogs that kind of run the whole mortgage industry, have pulled those numbers down. But what we have to do is we look at how much debt that you have and versus your income, and we have to find like this middle ground. Some, depending on the loan program, as well as your credit score and your assets, will help determine of where you can stand with your debt to income ratios. Sometimes we could go, hold on, I'm going to pull this up for you because like I said, COVID is changing the guidelines constantly. And so I want to make sure I have some correct, accurate information based on today. But like I said, this could be different tomorrow. I never know right now. But right now with our debt to income ratios, on FHA, we could get approved up to 47% max front end. And the front end ratio is your housing expenses versus your debt. Your back end ratio is all of your debt versus your income. And we could get up to 55. But like I said, it all depends on your own factors of your assets and your credit score. And then there's a conventional loan, which the max CTI is 50%. We do notice when we run our automated underwriting system that the back end is now sometimes holding as low as 43%.
Wow.
So like I said, it's really hard to like fully give you an exact number, but it plays a huge factor because if we aren't within those debt to income ratios that are being like allowing us to get you that loan, we can't, like we're stuck. So there's a lot of times I have to help people and be like, okay, you need to pay off this credit card and that credit card, or can we pay off your car to make this work? And so it plays like a huge factor. I cannot express that enough.
Yeah. He's like a secondary financial coach for people as well. Like, hey,
sure.
pay down some of these debts. Absolutely.
Okay, so we have a lot of people wondering, when do you buy a house? Like, what's an appropriate time? Is it being a certain age? Do you have to have a certain amount of money saved up? Or I think we were told you can't buy a house until you've been with your career for X amount of years. Are there certain jobs that don't qualify for that?
All jobs qualify for that. It's 2 years. They want to see is 2 years of you within the same employment, like with the same employer. The only time that wouldn't count is if you're salaried. We could normally give you that income if you're salaried, because what we do is we have to use the 2 years and we do an estimate or sorry, not an estimate. Yeah, I guess it would be an estimate. Okay, so we do an estimate of your overall income between those 2 years to see exactly what your monthly income looks like. Because let's say in 2000, 2019, you could have been making less than 2020, or vice versa. And so we're going to we add those numbers together and divide it by the months to give you the exact monthly income. But if you're salaried, what that does is we know what your income is. It's not going to change. You're always going to be that. So we could give you a loan if you're salaried and it's a new job. We could also give you a loan if you just came out of college and you went to college for the degree of where you're working right now. Kind of like, I know your brother, and you guys went to college and to become teachers. So we were able to give you guys loans based on you just getting out of college and becoming a teacher and not having to have a 2-year history. So that kind of gives you the example of if you go to college and work for it, it shows that you at least have some dedication within that career. And as for your question on when is it the right time to buy, that is dependent on each person. Some people aren't ready to buy. I know people who are 60 years old and still rent. And there's nothing wrong with it. It's a personal preference. I know some of them just prefer that. However, you could buy, as young as you want, as long as your ducks are in row. And so if you feel ready and you want to look into it, I can't tell you when to buy. It's really when you feel ready and you're financially ready and you have a job security. It's kind of, you got to be set up.
So for all of you guys listening, what she really just said is that when you're sitting here trying to think like all of my friends and all of my family, they all own homes and I just can't get there yet. That's okay. Like, no one has the exact same timeline. We are all doing things our own way, and it's going to be your own adventure to get where you need to be. So maybe you have a career change. Justin was a police officer, and then he decided to go back to school to become a teacher. So that whole entire career shift or wherever you are, that's going to affect when you buy a home. Also, when you have money and all of that. So if you're not there yet, don't feel bad.
Yeah. Definitely. Kelly, what's considered a good down payment? And if somebody isn't able to save up a large down payment, particularly speaking here in Sonoma County or some of the neighboring counties where it's really expensive, what options do people have?
As for a good down payment, I would like to say any down payment is a great down payment. If you have enough to actually buy a house, there we go. That's awesome. What an amazing down payment is 20% down, and the reason for that is because you don't have PMI, which is private mortgage insurance, which is an extra fee on you each month. And so once you put that 20% down, it gets rid of that, and then you save money monthly once that's gone. So that's always an awesome thing to do. But you know what? I bought a house and I only put 3.5% down. So no, it's, I'm in the industry and I put a small down payment on my house. So it's really whatever you can afford and do. Yeah. And what was the other question that you said?
I guess you kind of answered it, because if you only put 3.5% down, then the point being, like you said, any down payment's a good down payment. So I guess the options are, if you can't hit that 20% down payment, to scrape together whatever you can and just call Kelly and see what can happen.
Yeah.
So is having private mortgage insurance a good or bad thing? Does it break the bank, or what do you think about that?
So I think it is, I wouldn't say it's a bad thing, but I wouldn't say it's a good thing. So it's not a bad thing because you at least got a house, right? You're paying extra each month to guarantee the lender that you're going to make those payments. And it's insurance. If you default, it's promising that the lender is going to get, their money back of the loan, so that if you default, we're not out. But it's obviously better not to have it if you don't need it, because then you save money. And I see anywhere from sometimes $300, $400 a month. It really depends on the house that you buy and the purchase value or price. But yeah, so it goes either way. You can't really say it's good or bad.
After you put X amount of dollars in your home and you have appropriate equity, does the PMI go away?
So yes and no. So it goes away. Let's say you've been paying down your loan, and then all of a sudden you got an inheritance and you're like, I'm going to pay down my loan, and you just throw money down onto your principal. It's not going to go down if it's been with less than 2 years. So it has to be on there for 2 years before you could take it away by paying it down. If you refinance and your value's gone up and you refinance, then yes, it could be taken off. But it does not get taken off until technically 78%. It will automatically be taken off, and that 80% you could call and ask for it to be taken off. However, it really just depends if you're still within that 2-year range or not. But yeah, it eventually goes away, but only on conventional loans. FHA loans have it forever.
Wow. Well, I mean, but again, if it gets you into a home, and that's what the important thing is, if you set it up appropriately with your income, then you can at least make it work to start getting some equity in a house. Kelly, what's the difference between a 15-year mortgage and a 30-year mortgage, other than the obvious of it being one's shorter and one's longer? Is there a big difference?
It's literally that. The only difference that I see is that there are better rates on the lower, on the 15-year versus the 30. But that's because there's less risk. However, you're paying more each month to pay down, your actual loan. But it's just literally the loan term. There's not a huge difference in them. So it's more if you qualify for the bigger down payment or not. Or not down payment, the monthly payment.
Yeah, and we've heard, in the podcast that we listen to, some people say, well, I have a 30-year mortgage, but I pay it like a 15 because I just throw money at it monthly to get it to knock down. And that's still an option. If you can't afford that higher monthly payment in the 15, but you can throw a little bit extra on the 30-year, you might still get out of it, under that 30-year term. So I always thought it was so much more intricate. I'm like, wait, if it's 15-year versus 30, there's got to be some other catch. But I guess it's just at the 15-year, you might pay a little bit more. And that's about it.
I remember when we did the refinance, the most recent one for the lower payment at the beginning of the coronavirus. And I had you do the quote on the 15 and the 30. And the 15 was significantly way more money going towards the principal every month. But the monthly payment was almost $1,000 more per month for the entire payment. And that our mortgage payment includes the escrow, so the insurance and the property taxes all together. But still, we can't afford, that would have been 60% of our take-home pay. So that's just ridiculous. But I guess if you live somewhere like Nebraska and you can afford that because your houses aren't
Sonoma County home prices.
Yeah, I mean, a cheap house here is you're lucky if you get under $500,000.
Yeah. Crazy.
Okay, so you mentioned conventional FHA. I know there are many different types of loans. Can you kind of tell us the difference between FHA, fixed rate mortgage, conventional, adjustable rate? What are all of those?
Yeah, so an FHA loan, I like to say, is great for first-time home buyers. I mean, that's what it was initially made for, or at least what I was told, but it's great for people with lower credit scores, or people who, might not have as much money to come in with, and you're going to have mortgage insurance or PMI either way on a conventional loan, and FHA sometimes has the better rates. So it's a nice starting place for people. And sometimes you stay in them forever. I'm in an FHA loan and I'm in the industry, but that was because I didn't have enough money to put it down on a conventional loan to actually get rid of my PMI. And that with FHA, I had a lower rate, so it made more sense. A fixed rate mortgage is literally, it means it does not change. So let's say you have the 30-year, that means for 30 years, your rate's going to be the same. Same on the 15. The rate is not going to change. An adjustable rate mortgage, it depends which loan product you were to choose, but it means you could have it where it's set for 5 years and then it's going to change after that to whatever the current rates are. And it's kind of a scary thing. I have never put anyone in an adjustable rate mortgage because you never really know where the market's going to go. right now interest rates are so low that an adjustable rate mortgage doesn't make sense, even if you are only playing in like a 5-year term, like with a house. Some people are like, I'm going to live here 5 years and then I'm going to flip it, or and move away. I still wouldn't advise to that. I've had only one person ever ask for adjustable rate mortgage, and it was a older man who has owned multiple houses, and he was well experienced and understood the fact that if you don't get out of it before the end of before the end of the fixed rate, then you don't know where it's going to go and you could possibly not afford it. VA loans is for veterans or people who are enlisted in the military, Navy, and whatnot, and it helps you get into a house with 100% financing. The only thing that you would have to come in with is with your closing costs. And VA does require a full clean pest report. So one of the things is my fiance, he is actually considered a VA. And we went with the FHA instead because our house is not 100% perfect condition, so VA wouldn't have allowed for us to buy the house, so we went with the FHA. So it just because you're a VA, it might not be in the best interest for you, depending on what kind of house you're looking at. So USDA is a loan that also allows for you to put down 0% and only come in with the closing costs. However, it's for rural areas. And so you have to go into the HUD site and put in the address that you're interested in to see if that property resides within that area that HUD designates as a rural area. And that makes it so you only have to come in with your closing costs as well.
I'm hearing so many options for first-time homebuyers that I never knew of before. So this is awesome. I'm so glad that we're doing this interview to get all of this information out there for people, because people don't even know where to start. And I feel like you're giving us just many different outlets for people to possibly look into. So thank you. This is awesome.
Yeah. So Kelly, we know that right now, because of the COVID-19 shutdown, the interest rates have changed. Can you kind of explain the process that happens when somebody is approved, or the decision process that goes into somebody's interest rate? Because I know that it's not always the same for everybody.
What determines your interest rate is actually going to be your loan to value. So the amount of loan that you have versus the value of the house, as well as your credit score. And that is going to determine what your rate is going to be. Rates change daily, sometimes multiple times a day. So I can't quote any rates for you guys because each person is so different. But the nice thing I can say is right now rates are lower, which is great. And yeah, I did want to kind of let you guys also know, like with refinancing, we didn't touch so much base on that. I think it's also a good thing to realize that when rates are low, refinancing is always a good thing to look into. And there's two different reasons people refinance. One of the reasons for refinancing is to get a lower rate, and it's called a rate and term refinance. And that's what you guys did recently, where we just lowered your rate to save you money. And then there's also a cash out refinance, which is where you could actually pull cash out of your equity and use that cash for, remodeling your home, paying down debt. And often I see people paying down debt with it, which is great because it saves them money in the long run. So
we did that.
Yep. I think that was 2 times ago.
Yep.
Yeah. Yep. We are guilty of that one. We don't necessarily look back on our cash out refinance and think it was a very smart idea because we put the money on a depreciating car. We did put some of it into the home for like the bathroom remodel. But what are your thoughts on taking out money from your equity of your house to pay down debt? Like, what do you think about that?
So I think that it can be positive, dependent on what you're paying down, right? So I can't tell you what to pay down or not. Like, it's not, it's your personal preference. If you want in that car so badly, then, then that's your choice. However, I do see a lot of people with home equity lines of credit that will come in and refinance to get those off, and they'll pay those off, which will make it so instead of having 2 interest rates, they now have 1, and it saves them a big chunk of money each month. And so when things like that happen, or if you're paying down credit cards or loans, other loans, and in the long run, if you break it down, you're like, okay, if we pay off this debt by pulling a little equity out, we're going to save you like $500. Like, does that make sense for you right now? Yes, it's going to be in a 30-year long term with us having this, new higher loan, but you're saving this much money now for X amount of years. And so it's kind of more weighing out your situation and, kind of where your life stands within the moment.
Especially, I think, as careers get, as people get deeper into their careers, we tend to earn more money down the road. So if you're in a career that's not getting you a ton of money right now, then maybe it's smarter to kind of refinance and take care of some things so that when you clean up your income in the future, it's a little bit easier to attack that. That makes a lot of sense, definitely. So Kelly, we want to wrap up with a question that we're going to ask all of our interviewees, and we think it's super important because Haley and I have made so many money mistakes, and we want to be as transparent as possible, and we want to get good advice. So if you could put a stop sign on the path of someone's money journey from your role as the mortgage loan officer, where would you put that stop sign, or what would you stop them from doing?
I would stop you from opening up credit cards. I would stop you. I would stop you from buying a new car, especially if you have like even a thought in your mind of wanting to buy a house. Buying that new car can make it so we don't have a deal. The other thing is, like, a lot of people will get into escrow and they'll be like so excited, right? Like, you're in this new house, you're stoked, and then they go and get like an Ashley Furniture credit card to buy some furniture and buy a couch and a table. And you know what? It kills the deal sometimes. And we're like, what are we going to do? And we will strive to try to fix your issues that, all of your little things that you mess up. But sometimes things are irreversible, and that couch is already on its way. So, no new debt.
Yes, that's so funny because when we were going through the first refinance, I remember you called us and you were like, "Hey guys, there's a new credit inquiry from Ashley Furniture. Like, what is this?" And we're like, "Oh yeah, we went and financed some couches. Like, can you guys please type up a document saying exactly what that is, because this is like not the time." Oh, that's too funny.
Hey, at least it wasn't a car, okay? At least it wasn't a car. That would have been way worse. Your couches, worst case scenario, we could have returned them. We made it work, though. We made it
$40,000
work.
car might be hard to return. Oh boy. That's too funny.
Thank you so much. This has been so helpful. I really appreciate you coming on here and helping us really sort out some things that we were a little confused with. And we've been through this process a few times, and I still had so many questions. So I really appreciate you clarifying this for us and for all of our listeners.
Definitely. I think the listeners, we ran the Instagram poll, and the home buying process was the biggest thing that millennials are just so lost on. And we recognize that it's a really important, we find a lot of value in it, and having that equity in home is so important, but people just don't even know where to get started. So it was really important for us to get this to be the first interview and to be the first series, the real estate series. So Kelly, one more time, how can people connect with you if they want to reach out and maybe even start the home buying process for them? Are you only able to work in Sonoma County or California? Are you able to work, all across the U.S.? And your phone number and any social media sites that you want to tag, please feel free.
Yeah, so I can only do California. Maybe one day I'll expand, but you have to go there and get licensed. So all of California I could do. And one thing I just want to say real quick is, don't be scared. You have to find a starting place. You have to at least call and see where you stand, and make that plan. If we can't have the starting place, and if you're too scared to actually find out what your scenario or what it might look like for you to buy a house, then you're going to just be stuck there. So do call and do see, if and what it looks like for you to get to where you want to be to buy your own home. And as my phone number is 707-888-5651. Yes, that is 3 8s. And then I'm on my Instagram, and it's at Hippie Lioness. And then I do have a Facebook, obviously, and a LinkedIn. But my Facebook is literally just Kelly Pennington. Yeah, look me up and I'd be happy to help you.
Awesome.
I appreciate you for inviting me on and being your guys' first speaker.
Yeah, thanks for joining us. We'll definitely put your social media links and the phone number in our show notes as well, so people, if they just listened way too quick in the car and they're like, oh shoot, I really want to give her a call on my lunch break, well, they'll be able to find you again without having to scroll through the audio track, for sure.
Well, this was awesome. Thank you so much. I'm so excited to hear what everyone thinks about this information. So, Kelly, one last question. Can millennials buy homes?
Yes, they can.
Yes. Ooh. Thanks so much, Kelly.
All right, guys. Thank you so much for tuning in. We really hope that interview was informational for you. We actually learned about the 3.5% down payment. We had no idea that was even an option. So we did some math for you guys to really map it out for you to see maybe this might be a realistic thing for me to do in my near future. So with a $200,000 home in some states where we live, a $200,000 condo or townhouse, if you were to pay a 3.5% down payment, that's only $7,000. If you have $7,000 and that's what you're aiming for, this is doable for you. So also keep in mind that when you are looking for your first home as a first-time home buyer, this is not your dream home. So this might be smaller than what you're looking for. If a townhouse or a smaller home with less bedrooms is something doable for you at this time and you can squeeze into it, buying a home is a reality for you.
It's 1,000% a reality. So if you think you've got that opportunity, we really, really push you to reach out to Kelly, see if it's something that's feasible. We've listed her information in the show notes, so check it out when you have a free second and contact her. See what she can do for you. Even if it's a no, like we said in the interview, maybe she can put you on the right plan moving forward. And if she gets you on the right plan moving forward, then you definitely want to stick around and listen to next week's episode, because we have on Gabby Demick. She's a millennial realtor in the Boston, Massachusetts area, but she can give you some insight into the home buying process from the realtor lens. And we are so, so excited to share our interview with her for you guys. That's going to be a wrap on this episode of The Price of Avocado Toast. We are so thankful that you guys stuck around to listen to this interview, and we are so, so thankful to share this community with you. As always, happy budgeting.
You've got this, Toasties.
If you're interested in speaking more with a financial coach, hit up our coach Ryan at MeFinanciallyFree on Instagram. Use the promo code HELP50 in the consultation notes section to receive 50% off.
Thank you for listening to The Price of Avocado Toast. Be sure to subscribe wherever you listen to podcasts. If you vibed with this episode, we would love it if you shared it on your social media and tagged us so we can say thanks.